So that person who has lost his home, of course, his spending will be increased. So he will be taking out more money from the bank. On the other hand, the banks invested in the housing sector. They gave funds to MNCs and all those stuff, those who are building, house contractors and all those stuff. So they cannot recover their money and to pay to the depositors. So it chain reaction started. So my house gone, now I want to make payments. I cannot draw money from ATM. And ATM says, you have the money, it's just a number, but we don't have cash at the moment. Plus, when housing sector start declining, people are losing their jobs, so they don't have much to spend. On the other hand, the economy is going down. So what happened? So loans, financial institutions, they are reluctant to give loans to the MNCs. Why? Because MNCs, of course, their products will not be sold because economy is going down. They are making more products for the people. People cannot buy because they are losing money. Economy is going down. So what happened at that time? There's a chain reaction started, and we have a credit crisis which become financial crisis throughout the world. Chain reaction started because everything is linked together, right? Now, international bond market. So we have talked about the money market, then credit market, and now bond market. We also talked about in our previous class the derivative market, in which we talk about future, forward, and options. And now bond market. What are the bonds? So foreign bonds are issued by borrowers foreign to the country where bond is placed. So since we are talking about international bond market, it means we are talking about bonds that are issued in foreign countries, right? So foreign bonds, the term foreign bonds mean, for example, if a company, let's just talk about company Alibaba. If Alibaba issue their bonds in China, do we call them foreign bonds? Answer is no, because Alibaba is a company of Chinese, right? So they are introducing bonds in China, so it is not called foreign bonds. What if Alibaba issue bonds, want to gather money through bonds from US? Then we call this is foreign bond. What are the Euro bonds? Euro bonds are bonds sold in countries other than country of the currency denominating the bonds. Simple. If Alibaba issued bonds, but bonds are in dollars, not in yuan, then we call this, these are the dollars outside United States, these are the euro dollars, and since they are gathering dollars from bonds, so we call this euro bonds. So euro bonds are bonds sold in countries other than the countries of the currency denominating the bond. If the currency is dollar, it should be issued in US, but these are issued in Europe or Asian countries or in Mexico, right? So we call these euro bonds. So partially a result of the interest equalization tax imposed by the US government in 1963 to discourage the US investors from investing in foreign securities. So we had the phenomena in 1963 because money flow from that country which offer low interest rate to higher interest rate countries. So because money was going out from US to other countries, so US will be, US at that time, had gone through some kind of crisis. So they banned, or how they banned, they impose equalization interest taxes. So what, for example, if in US the interest rate is 5%, and if in other countries interest rate in dollars is 8%, so the US government says that you earn extra 3%, so we are going to tax it, so that they are discouraged to invest in other countries. So if you are investing in euro bonds and you are US investor, your currency is dollar. So remember to account for after tax interest rate. If in your country in US it is 5% and in other 6% country, if you invest there, maybe after reverting back to your interest, you actually earn 4.5%. Why? Because you have to pay taxes, and taxes are huge. So you need to be very careful when you invest in dollars in other countries to capitalize or want to earn on interest rate. So remember that one, always consider after tax interest. If even after tax interest is higher, then you will say that okay, we got some benefit to invest in dollars in other countries. Okay, any question? Everything is clear? Okay, let's move forward. So the features of euro bonds, like any other bond, it is the same, only one or two things. That is, it is a bearer bond, which means whoever has the bond is entitled for interest received. It doesn't mean that it was my bond and I sold the bond to other, right? But interest I will receive because bond is for on the name of on my name, so I should receive the name. No, whoever holds the bond will receive the interest. Simple. And interest will be paid on annual basis. Third, these are convertible or callable bonds, which means the issuer has the right to call the bonds at any time. Right? If interest rates are higher, or if interest rates are lower and the issuer is paying 10% and in the market it is 5%, then he will definitely say that I acquire loan from you at 10%, but if I go to the market, I will be only paying 5%. So he will call the loan, pay you interest now and all the stuff, and call loan from market, which is giving you 5%. So this feature is called callable feature or convertible feature. Convertible can be in terms of cash and can be in terms of shares as well. If company says that okay, we don't need the money, we still have 3 years to retire the loan. What if we don't give you interest rate? Instead, we are giving you shares of the company. So if that feature is this one, then you cannot negotiate on that one because you signed on the contract that whenever company calls or convert, you say yes, or otherwise you will receive the money and that's it. So denominations, the bond will be mentioned that which currency it will be giving you interest payment and which currency it will be taking from you. Because one MNC is at the time issues many bonds in local currency and in foreign currency as well. Right? So in US maybe it required dollars, so he issues or it issues bonds in dollars. In Europe it requires in euro, so it issues bond in euro. So everything will be written on the bond face or bond paper or bond soft copy that we will be giving you interest rate in euro or in yen or in pounds or whatsoever. So what is underwriting process? Because since MNCs or government loans are huge, so couple of banks, they gather together and they will and that banks can be multinational as well. One from US, one from Japan, and one from Russia or maybe Britain. They join hands together to satisfy one loan, and one leading bank will say that I will be the underwriting. Underwriting means I will issue for negotiation, and if one of the banks cannot make a full payment, then I will be paying on his behalf. For example, Russian banks say that I will be contributing $1 billion, but Russian bank only have at that time 0.8 billion. So the leading bank will also add 0.2 billion to satisfy his contribution. So we call this underwriting. So if loans are not made completely, so underwriter, those who are underwriting the procedure, he will be responsible to. Company need only 1 billion. So company will be receiving 1 billion. No matter whoever said whose, the underwriter will provide the extra money. Now, secondary market. So first time when bonds are issued, we call that primary. So when those already have the bond, now they want to sell the bond to some other banks or some other customers, we call that secondary market. So market makers are in many cases the same underwriters who sells the primary issues. So primary issues mean first time when bonds are issued, the issuance is called primary market or primary issue. So when they are reselling it, we call this secondary issue or secondary market. Guys, are we clear? EGA, Rugier, Tiffany, Lancelot,
Yes.
Oliver, Sufyan. Good. Now, development of bond market. Bond markets have developed in Asia and South America very well, right? And why is that? Because Asian companies and South American companies are now, they are becoming huge and they are expanding their business to Europe, to America as well. So they also need money denominated in other currencies as well. Remember, bond market yields or their bond market returns among countries tend to be highly correlated over time, like we saw in the case of short-term interest rates. Because if I am the company, I am issuing loans, so I will issue loans where the interest rates are lower, right? And when I gather loans from there, short-term interest rates start rising. So due to me, because I gather higher money from that country, so that country interest rates start rising. So that's why everything is correlated. And which kind of correlation? High correlation. So when economic condition weakens, aggregate demand of the funds decline, and with the decline of corporate expansion. So as a buyer of the, for you guys, as a buyer or of the loan or of the bond, as the buyer of the bond, so remember that one, if there is, if the prediction are that the economy is not doing, is not going to do well, so remember that one, companies, they are making products is not going to be purchased by local public. Why? Because economy is going down. And what happened if you already gave them a loan? The chances are that they will not be able to return the principal and interest on time. Default rates start increasing. So in that case, you will receive less interest. So the price of the bond start decreasing. So managerial implication is that whenever economic condition is weakened, at the moment, please sell your bond as soon as possible. Get rid of the bond. Why? Because you will receive the interest payment late plus the market value of the bond start decreasing. So that is pure financial concept you will learn in financial management.